Assalamualaikum and hello everyone. My name is Natra binti Roslan, metric number 264408, and I'll be continuing the presentation with the definition of income under the Act. So the definition of income as stated by Lord Denning in Delivering Heater versus Consulting Group Ltd, it is a case concerning whether the payment is capital or revenue. Is equally applied to revenue or capital receipt. He mentioned that the question of income or capital is a question which have been repeatedly asked by men of business, by accountants, and also by lawyers. In many cases, the answer is easy, but in the other, it was so difficult. The difficulty arises because of the nature of the question itself. In this case, it shows that the definition of income has been long questioned by many professions, since there is no exact definition that has been stated in the Income Tax Act or any other act. So, it is important to examine its boundaries. Even the exact definition is not stated in the Act, but it merely categorizes the classes of income in Section 4, which is classes of income on which tax is chargeable. There is 6 points on the section that might help in categorize the income, which is gain or profit from a business, gain or profit from an employment, dividend, interest or discount, rent, royalties or premium, pension, annuities or any other periodical payment not falling under any of the foregoing paragraph, gain or profit not falling under any of the foregoing paragraph. So, these are the 6 points that might help us in recognizing the definition of income. By knowing Section 4, we can at least recognize income, since the general and the ordinary definition of income should be employed as stated in Section 4. The factors such as nature of consideration for receipt, the ordinary cost of conduct of business or employment, and the periodicity of receipt would be considered to determine whether a receipt is capital or income. Next is about the definition of business. As mentioned in Section 2, Income Tax Act 1967, business include profession, vocation and trade, and every manufacture, adventure or concern in the nature of trade, but exclude employment. So in short, this statement states that there are several points that have been highlighted in the definition of business, which is profession, vocation, trade, manufacture and adventure or concern in the nature of trade. We'll be presenting about each point. The first point is profession. The word profession used to be limited to 3 learned professions such as church, medicine, and law, but now it is referred to a larger extent. Profession is an occupation that's related to one's skill and qualification that is earned through higher education or specialized training. For example, a surgeon, a lawyer, or an accountant can also be considered as profession. There are several cases that can support the term profession. First case is the Commissioner of Inland Revenue versus Maxis. In this case, it mentioned that profession in the present use of language involve the idea of occupation requiring either purely intellectual skills or any manual skill, as in painting or surgery, which is substantially the production or sales or arrangement for the production or sales of commodities. This case, the Court of Appeal held that the journalist whose contribution have many literary forms as distinguished from a reporter was exercising a profession, since profession can be carried out either by a company or an individual. Second case is FY versus DGIR. This case is about an argument being made by a professional public entertainer who considered her floor show as a profession. So the tax should be taxed on the business income and should not be employment income. The payment received from service provided should be under Section Business Income, since it is considered as a profession. The third case is Crook versus Inland Revenue. This case is about the business of portrait photographer, which is not considered as a profession and accordingly not exempted from any access to profit duty. And the last case is the Synex Investment Ltd versus Revenue and Custom Commissioner. This case is about the redevelopment of a church and the use of it. since the premises that are being redeveloped are used for other activity which is not related to any religious activity. So the issue is whether the premises purchased and partially redeveloped by Sinex had last been used for the purpose of trade, profession or vocation, and should the income gain should be taxed under the business income.
Assalamualaikum and good morning to lecturers and my fellow friends. My name is Nafaka Fitri binti Zahidi with matrix number 273911. Today I would like to present my part, which is vocation. Vocation is any trade a person has knowledge on, or he or she is suited, trained or qualified. Other than that, it can be an activity a person earn income from daily or what he or she uses to pass time. Someone in a vocation may learn the trade from another person who has the knowledge and practices it. The related case for vocation is B. Western Commissioner of Taxes and B. Magistrate Court Hamilton. The issue is whether the profit earned by the appellant are chargeable to tax. Based on this case, the appellant is a married man. He has been for some 15 years employed as a butcher in a retail shop. The appellant declared that the only income derived by him for each of the 11 years was the wages he received. But the commissioner asserted from the Post Office Savings Bank that he had also received interest on his deposit and an inquiry began. The argument was they contended that he had not discharged the onus on him of proving the $800 came from betting, and even if the money came from the betting described, such betting was the appellant vocation, and even if it were not his vocation, the profit are accessible. The judgment is clear that the tax proprietors quoted are unanimous in their opinion that the ordinary punter whose life is entirely dissociated from the race course and activities connected therewith is not liable for profit from betting, and that before he could be held liable it would have been to be shown that he was conducting such betting as a vocation. The appeals are all allowed with the solicitor's fee and cost and witness expenses to be fixed by the registrar. Next case is Patrice versus Melendin, Surveyor of Tax. The issue is whether the profits earned by the appellant are chargeable to tax. These cases are quite similar from the previous cases. Is the fact of the case is the appellant is a professional bookmaker who systematically attend race courses for the purpose of carrying on the activity. The appellant attended race, made bets and earned profit, but they were not assessed to the income tax. The amount of assessment was not questioned, and the appellants were not prepared with any accounts of their profit, as they destroyed the betting books at the end of each year. They also could not legally recover any amounts due to them in respect of that. The argument is they contended that they had not trade, profession, calling, or vocation within the meaning of the several act relating to income tax, and that the profit made by them from attending race courses and betting, as aforesaid, were not legal profit or gains, and were not accessible to the income tax. The judgment is that the respondent contended that betting systematically and annually carried on came within the provision of the Income Tax Act as a vocation. Therefore, the decision was that the profit or gain received by the appellant therefore were chargeable to tax. Next is trade. Trade is something where the buying and selling are the most obvious characteristic. It is a principle used to determine whether the transaction is of business or capital nature. A trade is defined as including any venture in the nature of trade. Besides that, the courts have developed a number of tests to determine whether somebody is trading. The case for trade is Frazen versus Canada. The issue is whether the land held for resale as an adventure in the nature of trade may be valued as inventory of the Income Tax Act. The fact of the case is the appellant bought a parcel of land for the purpose of reselling it at a profit. In the years immediately following its acquisition, the property substantially decreased in value and was eventually foreclosed. The appellant sought to deduct the decline in the fair market value of the land as a business loss. The appellant argued that he was entitled to make such deduction. The Minister of National Revenue disallowed these business losses on the basis that the property was not an inventory in a business. The judgment was the appellant is able to claim under the ordinary tracing formula proceed less the purchase cost, or the drop in the value of the land in the year in which the property is disposed, but not in years where the property remained dormant. The next case is J. P. Harrison, Watford versus Griffith, HM Inspector of Taxes. The issue is whether the shares of a company constituted a trade or an adventure in the nature of trade. Fact of the case is the company purchased all the issued share capital. Shortly afterwards, Julius Bandit changed its name to Claiborne. The shares of Claiborne were bought by the company on a brand transfer which was not registered and was passed on the purchaser when the company sold the shares on 4th June 1954. At that time of the purchase of all its issued shares by the company, had no business but had considerable accumulated profits available for dividend. It was simply a company pregnant with dividend. The company purchased the shares with a view to obtaining a dividend against which it could claim to set off its losses. The gross amount of the Claiborne dividend is shown as credited to the company's trading and profit and loss account. The argument is there is no evidence that the company bought or sold any shares in the year 1953 or 1954, apart from the purchase of the said shares in the Claiborne. The company was not carrying on a trade or an adventure in the nature of trade. The judgment, the company transaction in the share of Claiborne was not entered into as part of any trade of dealing in shares and was not an adventure in the nature of trade, and that the company was not carrying on any such trade.
Next is about manufacture. Manufacturing is the production of goods through the use of labor, machinery, tools, and biological or chemical processing or formulation. Manufacturing can either mean transforming raw material into finished goods on the larger scale or the creation of more complex items by selling basic goods to manufacture for the production of items such as automobiles, aircraft, or household appliances. The case that can be used as supporter in manufacture are: first is the Aditya Mills Ltd versus Union of India. In this case, manufacture is defined as a process where the original material must undergo a transformation so that a new and different article or product emerge. The new substance or article must have its own name, character, and use. And the next case is about Chan Wei Lun versus Public Prosecutor and other appeals. In this case, it mentioned that the trial judge found that the shop house was used as a drug manufacturing factory based on the seizure of various types of machine, apparatus, and chemical substance that can be used for the production of those drugs. The third case is the Ukilan Manufacturing Sdn Bhd and Arno versus Dato' Wong Gek Meng. This case is about the injunction granted to restrain defendant from manufacturing the cosmetic sponge product resembling those plaintiff. Lastly, the fourth case is Optoplast Manufacturing Company. This case is about there is a combined nomenclature explanatory note in the form of plastic sheeting of the container process and the detail of the process of the manufacturing that might support the definition of manufacture.
Adventure or concern in the nature of trade. Malaysian income tax imposes tax on transactions that give rise to income. An isolated transaction would be taxed as business income if it fell in a trade or adventure or concern in the nature of trade. In the event an isolated transaction is seen as realizing an investment, the surplus is a capital gain and thus is outside the ambit of income tax. The case that related is PM Muhammad Mirahan versus Commissioner of Income Tax. The issue is whether the transaction constituted a venture in nature of trade and the surplus was accessible to tax. The fact of the issue is the appellant had escaped from being charged on income on the sales of estate. The income tax officer held the appellant profit from an adventure in the nature of trade and included this amount in his total income under Section 34(1)(a) of the Act. The appellant took the matter in the further appeal. If a transaction related to the business, which is normally carried on by the appellant, though not directly part of it, as intention to launch upon an adventure in the nature of trade may readily be inferred. It was held that the appellant carried on an adventure in the nature of trade and so the profit was liable to be taxed. Thank you.
I will continue the presentation. My name is Nurudiana binti Syakimi, 26497 3.1.2 Badges of Trade. Badges of trade is method used by HM Revenue and Custom to determine whether an activity constitutes a trade or adventure or concern in nature of trade. HM Revenue and Custom HMRC now listed 6 badges of trade which are profit-seeking motive, period of ownership, method of finance, development or processing of asset, nature of subject matter, and circumstances leading to realization. The first one is profit-seeking motive. Profit-seeking motive is about a person is having an intention of making a profit may indicate a trading activity. As evidence of trade is more easily assigned to a company or partnership, is normally that it is a profit-making concern. If an individual buys and sells at a profit, and if the transaction is isolated, he may be required a merely realization profit on capital investment. Now let's see the case related with the seeking profit motive. The first case is Insaf Tegas Sdn Bhd vs Ketua Pengarah Hasil Dalam Negeri. The issue is whether disposal of appellant land constitute disposal of capital investment or disposal of stock in trade. The appellant is a company principal involved in the business of property investment. On 16 January 1997, the company purchased 50 acres of land in the Mukim Batang Kali district of Ulu Selangor from one company, Ligasmas Sdn Bhd. The company subsequently disposed the land to the Midswest Sdn Bhd by the way of deed of assignment dated 16 April 2004 and 24 May 2004. The appellant submit a tax return for RPGT. The respondent issued a certificate of exempted RPGT and a notice of assessment against the appellant income for the sum of 4,005,563 ringgit was issued, with penalty in the respect of gain made from the appellant disposal of the land. The court has dismissed the appellant and took into consideration the circumstances surrounding the appellant purchase and disposal of land. The court concluded that the appellant's intention for the land was not the purpose of investment, as was contended by the appellant, but as a stock in trade. The appellant clearly intended to develop the land for a profit, as evident from the appellant's execution of SPA with the Ligasmas Sdn Bhd. Hence, the appellant has to pay some of penalty for the incorrect return. The second case is Saud vs Chamberlain. The issue is whether the transaction carried out by the appellant in 1973 amounted to a trade. The appellant is a mathematics graduate whose academic study included the application of computer to the forecasting of share movement involved the analysis. On 15 January 1969, the appellant began to buy and sell on the stock exchange, and in 1973, the appellant made a loss in buying and selling of the stock exchange. The appellant had also borrowed from his bank to finance the transaction in the stock and share. Mr. Saud has disclosed the transaction as a trade of stock and share dealer for the year ended 1973, recorded at nil. However, in 1977, the Inspector of Taxes formally rejected the claim. Thus, the appellant appealed against the rejection. The appeal was dismissed and the appellant's transaction was not trading. This is because the trade must be bilateral, which means that you must trade with someone. The appellant cannot trade with himself and not liable to the assessment of tax. The third case is the Brown Rubber Syndicate Limited versus Farmer. The issue is whether £19,000 is liable for the tax. The Brown Rubber Syndicate Limited is a limited company involved in acquisition and development of rubber estate and cultivation and manufacture of rubber and sale of the whole or any part of the business. The company expended £29,500 in the purchase and development of the estate at the Tebrau, known as Baru and Lama. Due to insufficient capital to develop the estate until they reached the production stage, the company sold its whole undertaking to the new company at the price of £38,500. The appellant argued that the company was not an investment company to make profit by buying and selling investment, while the respondent argued that the company completed either cultivating or selling itself at a profit. They submitted that it was an operation of business in carrying out a scheme for profit making. The court reversed the determination of Commissioner and remitted to the company to discharge the assessment, order repayment of the income tax paid on the sum of £9,000 and discredited. This is because a person or a company has invested funds in the purchase of an estate which have subsequently appreciated and has realized the profit, does not make it liable to the assessment. The second is period of ownership. Period of ownership refers to the length of time an asset is held. The length of time an asset is held is important indicator of trade. A profit on sale will not be treated as trading if it is held for a longer time. However, if the asset only owned for a short period, it is much more likely that it was purchased with the aim of selling it at a profit. The relevant case is ALF Property Sdn Bhd vs Ketua Pengarah Hasil Dalam Negeri. The issue is whether the land purchased by the ALF Property Sdn Bhd is an adventure of nature of the trade. The appellant was incorporated with the primary objective of carrying on the business of property development and construction. The appellant purchased 7 lots of land at a public auction for $9,100,000 on 28 March 1980. The purchase of land was stated as being for the development of an office complex for the rental purpose. However, the appellant sold a part of the land for RM42,500,000 in 1990 as stated it was not necessarily for the construction. The respondent subsequently assessed the appellant to income tax amounting to $30,180,960 pursuant to Section 4, Subsection A of Income Tax Act 1967 on the basis that it had traded in land. The court affirmed the Special Commissioner decision and allowed the appeal as the effort to sell the portion of land was unsupported by the evidence that showed it purposely for trading. The land was maintained for 10 years from the date it was purchased and showed that it was intended for the investment property. Therefore, the land is not considered as adventure of nature of trade and exempted from the tax. The second case is Gerald SB vs Ketua Pengarah Hasil Dalam Negeri. The issue is whether the gain derived from the sale of trading receipt and taxable under Section 4 Subsection A of Income Tax Act 1967 as a business income or capital receipt. The appellant's principal activity pursuant to its memorandum and article of association that the company is investment holding company. On 28 October 1989, it purchased 2 parcels of land which it subsequently sold on 15 December 1995. On 11 April 2000, a notice of additional assessment for the income tax was raised by the respondent for the gain derived from the appellant from the sale of the land. The land has been held for 6 years after the acquisition. The appellant is exempted from the tax and not considered as business income. This is because the land was consistently held as non-current asset in the appellant's audited account, and the fact that they were held for almost 6 years before being disposed of is this evidence of the appellant's intention to hold the same for investment purpose. Next is method of finance. Method of financing is another important feature in deciding whether a trade exists. Borrowing to finance the purchase of asset may indicate the possibility of a trade as the owner has to sell the asset in order to repay the debt. The relevant case is Lim Fu Yang vs Comptroller of Inland Revenue. The issue is whether the surplus is the result of respondent business activity or it merely the realization of the investment. The respondent purchased 5 pieces of land at Kuala Lumpur and built a hotel on the site at the cost of $2,377,490, of where $2 million was borrowed from EPF board to which the hotel and its land were charged. The respondent made an agreement with the EPL board to sell the hotel and its land to the board for 5 million. The difference between the cost of building and the selling price gives a surplus of RM 2,622,510. The respondent sold to hotel company the rent and his right to repurchase the property. The sale of repurchase right was at a consideration of 4,201,000. The consideration are considered to be taxable. According to Special Commissioner, the mere fact that the property value exceeds the cost of acquisition automatically qualified the excess as a taxable profit from trading. The excess was a taxable profit from trading. According to Special Commissioner, the mere fact that the property's value exceeds the cost of acquisition. The second case is Wisdom vs Chamberlain. The issue whether the appellant had carried on a trade or an adventure in the nature of trade. The respondent was a man who earned a very large income. His assets were in the region of £200,000 in stock and share, government security, a country house and a yacht which has in the building. Due to the devaluation of the pound, Mr. Halpern advised Mr. Wisdom to find something against the dollars that would maintain its value and would be silver at a profit, such as ingots and bar of silver. Mr. Halpern wished to buy £200 worth of silver bar, but due to market disruption, he only managed to purchase £100,000 worth in respect of advice from the broker. Since he persisted in his attempt to purchase £200 worth of silver, he entered another £100,000 worth, and the transaction was financed by a loan at a higher rate. The Inspector of Taxes argued that the appellant had carried on a trade or an adventure in nature of trade and made profit which were assessable under Case 1 of Schedule D. The amount of the assessment would be determined accordingly, while the appellant contended that the profit was not trading profit but an accretion to capital. The court held that the transaction is an adventure in nature of trade. The transaction was entered in a short-term basis for the purpose of profit making out of purchase and sale of commodity. Next, I will pass to the next presenter.
Assalamualaikum and hi, my name is Nafara Izzati binti Muhammad Rizwan. My metric number is 264549. So I will continue for the next 3 pages of trade. Okay, for the development of processing of asset, when an asset is processed again, it indicates that the asset is being traded. This will making significant improvements to an asset if it has been acquired in order to make it more marketable. The relevant case that related is Cape Brandy Syndicate versus CIR. The issue is whether the profit from recast wine is taxable or not. Okay, this case is on about the appellants, which are the 3 members of a wine trade firm had entered into an oral agreement to form a syndicate independent of their respective firms. Their main aim is to obtain a quantity of brandy from the Cape government as a speculative purchase for sale on their joint account. The brandy was purchased in 3 installments from a Cape colony agent. A small amount of the brandy was sold on commission by the said agent, and the rest was shipped to the United Kingdom, where it was blended by the members' firm with French brandy purchased by the syndicate, then recast and sold it into the market. So, the court held that it is a trade because the transaction was a trading transaction. Hence, the profits become taxable. According to the true interpretation of the Finance Number 2 Act 1915 and the subsequent acts, any trade or business started after the outbreak of the war was subject to an assessment of excess profits duty. The next one is nature of subject matter. This one, where an asset itself does not produce any income or personal enjoyment to its owner merely by virtue of ownership, it is usually considered as trading in nature. An asset which was bought for own use and enjoyment with no indication of quick resale will generally not be regarded as trading transaction. An asset is acquired in a very large quantity and cannot be retained for personal use. It is pointed towards trade, not of enjoyment. There are two relevant cases which related to these pages of trade, which are the first one is Rutledge versus Inland Revenue Commissioner, and the other one is Cook versus Haddock. Okay, for the first case, which is Rutledge versus Inland Revenue Commissioner, the issue is whether the profits were liable to assessment to income tax or not. Okay, this case is about the appellant was a moneylender who was also interested in a movie theatre in 1920. Since then, he is been interested in the variety of business. In Berlin, in 1920, on business with the cinema company, he was offered the opportunity to buy a large quantity of paper for a very low price. He completed the purchase, and upon his return to the United States, sold the entire consignment to one person for a substantial profit. So, even though this was the only transaction by the taxpayer, he was held to be trading and the profits were taxable. The commissioners conclude that the profits were liable to income tax and excess profit duty assessment as profit of a business in nature of trade, and accordingly reduce the amount of profit chargeable to income tax to the sum and confirm the excess profit duty assessment. The second case is Cook versus Haddock. The issue for this case is whether the sales of Russell Hall Estate was realized as nature of trade or not. Okay, for this case, it's about the appellant was a solicitor and was also concerned in a partnership and three companies which had engaged in a property dealing. In 1948, he purchased a farm and land amounting to about 72 acres. To finance this purchase, he obtained approximately 2/3 of the purchase money by mortgage. The total rental value of the property acquired was £167 per annum, and the interest charge on the mortgage amounted to £320 per annum. The previous owner had obtained planning approval for the development of a part of the land and had constructed a service road to the estate. Following the purchase, the appellant submitted the same development plan as his predecessor for approval. He did not take any steps to develop the land himself, nor did he advertise it for sale. Between 1949 and 1953, he was approached by individual holders of building license and sold 23 building plots. In 1954, he sold a further 191 acres to a building company with an option for the sale of a further within 7 years. Okay, for this case, it was contended on behalf of the Crown that the purchase and sale of parts of the Russell Estate Hall by the appellant constitute the carrying on of a trade, adventure or concern in nature of trade, and that the profits or gain arising therefrom were accessible to income tax under Case 1 Schedule 6 for the relevant years. The last basis of trade is circumstances leading to realization. The circumstances leading to the sale of the property is an important consideration. If the sale is meant to realize profit, then there is an element of trading. The relevant case that related is Penang Realty Sdn Bhd versus Ketua Pengarah Hasil Dalam Negeri. The issue is whether the compensation received by the appellant as a result of compulsory acquisition of a portion of the land is taxable under Section 4 of the Income Tax Act 1967. Okay, the case is about the appellant bought two pieces of land, namely Haynes Estate in Penang and Haynes Estate in Perak. The evidence shows that a portion of the subject land, lot 2833, Bandar Tanjung Bunga, was compulsorily acquired by the government in August 1980. In May 1982, the appellant was paid the sum of money as compensation, where IRB sought to tax the said compensation and accordingly assessed that sum. The appellant was unhappy with the assessment imposed and appealed to the Special Commissioner of Income Tax, and it was dismissed. The appellant claims that the property was forced to be sold to the developer because the appellant's member did not take up the lots that were supposed to be sold to them. The appellant had no choice but to sell to the developer in view of the predicament in which it found itself and the inability of the appellant to raise funds from banks or financial institutions to finance its housing project, of which the beneficiaries were its members. So the Court of Appeal decided that proceeds received by the appellant, which is the Pinia Realty Sdn Bhd, were not subject to income tax. The Court of Appeal upheld the appeal, ruling that the government's compulsory acquisition of the appellant's land could not be considered as a sale with taxable proceed because the element of compulsion violated the intention to trade. That's all from me. Thank you.
Greetings everyone, my name is Nur Afifakila binti Mat Nasib and number metric 264529, and I'll be presenting for adjusted income from my business. According to section 33 of ITA 1967, it states that a person's income shall be adjusted by deducting all outgoing and expenses that incurred in production of gross income for that period of time. However, not all costs are deductible. Section 33 must be read in conjunction with Section 39 ITA, which offers a list of non-deductible outgoings and costs. The list includes domestic or private expenses, any capital withdrawn or sum employed or intended to be employed as capital, and so on according to the Section 39. So as you can see on the slide, this statement is based on ITA 1967 subsection 33(1). It states that the adjusted income of a person from a source for that basis period for a year of assessment shall be an amount ascertained by deducting from the gross income of that person from that source for that period all outgoings and expenses wholly and exclusively incurred during that period by that person in the production of gross income from that source. To qualify the deduction based on Section 33(1), the expenses must fulfill all the characteristics which are outgoing and expenses wholly and exclusively incurred in the production of gross income and also does not fall into Section 39. This information you can read on the website of our sources on the last slide for further info and related case. I will only tell a case that relates to the one of the characteristics mentioned, which is ongoing and expenses. The case that related to is Raleigh Estates Limited versus Income Tax Commissioner. As for this case, the appellant is Raleigh Estates and the respondent is Income Tax Commissioner. Raleigh Estates made considerable profits and they are liable to pay the income tax. However, it says there should be deducted several payments when calculating the income of Raleigh Estates. The Commissioner of Income Tax declined to make any deduction. Raleigh Estates appealed to the High Court. The court held that the settlement was not revenue expenditure but capital expenditure and was not deductible for the purpose of income tax. The conclusion for this case is the payment made for the purposes of generating capital are not deductible. However, where the payments are for the purpose of generating income, they are a revenue expense and would be deductible under Section 33. Outgoing and expenses referred to by Section 33 must, strictly speaking, be revenue in nature. It is not a capital expense. Now I'll explain for the capital and revenue expenditure. Capital expenditure is an expense that involves the replacement of the entire assets, while revenue expenditure is a replacement of some part of a more significant asset. Generally, an expense that fulfills the condition as highlighted in subsection 31 of the ITA 1967 may be deducted against the gross business income to arrive at an adjusted income. But the expenses that relates to fixed capital, acquire, modify, expend, incurred to bring into existence for the asset or business considered as capital are not deductible. For repair and renewal expenses, this can be claimed as deduction from a person's gross income from a business or rental source. Paragraph 31C of the ITA allows a deduction for the expenses wholly and exclusively incurred for A. The repair of premises, plant, machinery or fixtures employed in the production of gross income, or B. The renewal, repair or alteration of any implement, utensil or articles so employed in the production of gross income from that source other than implements, utensil or articles on which the expenditure would be qualifying plant expenditure for Schedule 3 of the ITA. However, the cost of reconstructing or rebuilding any premises, buildings, structures, or works of a permanent nature, or B. any plant or machinery, or C. any fixtures are not allowed as a deduction from the gross income in ascertaining the adjusted income from that source. To summarize the differences between these expenditures, if it relates to circulating capital, relates to business activities and recurring, it is revenue expenditure, which can be allowed as deduction. If it incurred to bring into existence an assets, relates to fixed capital, acquiring, modifying, expanding the business structure or asset, an initial expenditure, it is related to capital expenditure that cannot be allowed as a deduction. That's all from me. Thank you. I will pass to next presenter.
Assalamualaikum and good morning. My name is Anissa binti Abdullah, metric number 264898. So I will continue with initial repairs. As mentioned before, Section 33 of ITA 1967 must be read with Section 39, which explain the deduction that prohibited to be deducted from the gross income. So in Section 33, Clause 1 describe the characteristics of the expense that allowable to deduct, which should be outgoing, and expense which is wholly and exclusively incurred in the production of gross income. As stated in Section 33(1)(d), such other deductions as may be prescribed is the deduction that empowers by Ministry of Finance, which will be updated from time to time. So other than that, the deductions sometimes not allowable under ordinary rules, but in view of particular economic necessity, it can be allowable. So this is the list of the deductions that is prohibited to be deducted from the gross income. Next is special deduction provided in Section 34 of ITA 1967. In Section 34(2), the bad debt can be deducted from gross income in two situations, which are irrecoverable and partly irrecoverable. For irrecoverable, the amount that can be deducted is equal to the amount of the debt. Then for partly irrecoverable, the amount that can be deducted is the estimation of how much the debt is irrecoverable. Next, in Section 34(3), define the bad debt related to the deduction, which stated that the debt must already be included in the relevant gross income that make it qualified to be deducted if it is not recoverable. So this is the example case related to Section 34(3), CKB Limited versus Ketua Pengarah Hasil Dalam Negeri. So the first issue is whether the debt was in respect of a loan granted in the course of carrying on the taxpayer's business of the regular lending of money, and the second issue is whether the debt had become irrecoverable. So the decision is the Special Commissioners of Income Tax dismissed the appeal made by the appellant and delivered a judgment in favour of the respondent, which is IRB, that no deduction was allowed on the doubtful debt on the ground that the loan granted by the appellant to a company, SJT, to enable it to purchase the share of another company, HRS, and second loan granted to HRS were illegal, as HRS had acted against the Companies Act by pledging its property as security for the first loan. Both of the agreement entered into by the appellant were not legally binding. Thus, the grant of loan and the obligation to repay do not arise without a legal binding contract. So the question of debt arising within the meaning of section 34 does not arise. For the second issue, the decision held is a person carries on business with a profit-making motive. So a transaction which does not result in making a profit cannot be said to be one done in the course of carrying on a business. The appellant had entered into the transaction with full knowledge of its illegality and knowing it will preclude the appellant from recovering the loan. Therefore, the loan granted cannot be said to be granted in the course of carrying on the appellant's business, as the transaction does not result in making a profit. In section 34.4, it mentioned about the employer's contribution to an approved fund for the employees. Based on this section, the remuneration made by the employee consists of two types, which are remuneration as a whole and partly deductible. For the whole remuneration, the deductible is up to the contribution on 90% of the employee's remuneration, whichever is less. Meanwhile, for the partly deductible, the deduction is based on the part that is contributed by the employer to his employee. Next is section 34.5. In this section, it mentioned about the special expenses incurred by the business for the employees that is engaged on activities relating to the production of the relevant gross income, which is not stated in section 34.4, but it may be qualified to be deducted from gross income, which should be under concern of the Director General first. Lastly, in section 34.7, the deduction discussed is related with the research and development asset expense incurred by the business that deductible from gross income. This means that every expenses related with the research and development of the business, which is different with the expenditure incurred to set up the business, can be deducted under section 34.7. That's all from me. Thank you.